This is episode 130, Sensitivity Analysis in Multifamily Investing, Net Operating Income Cap Rate, and IRR. This is the 39.6 Facebook and YouTube Live Finance Show. The show that teaches high earners like yourselves how to make your money work for you so you don't have to work for your money. We talk general investing, taxes, real estate, syndications, Airbnb, paying for college, paying for childcare, and even the car you drive. Today, I am very excited to do a talk about sensitivity analyses in Excel. This is actually this is super fun geek mode. I didn't actually know how to do this before. I had to look it up, and I was like, oh my God, how did I never know how to do this? Because it is awesome. Using a two-variable data table to plug in different variables for what otherwise would be very complicated equations that you can't just readily put in as a long equation, and being able to run a bunch of numbers all at once. This is like auto magical. So here we go. We are going to show you how a sensitivity analysis works when we're trying to calculate IRR. You could use this for any variable, but IRR is like your kind of your be-all end-all catch-all number. It encompasses cash flow, appreciation, time, all these different things. Now, I can only show you two variables at a time in these. If you wanted to do like a three-variable sensitivity analysis, you need to have like some fancy three-dimensional structures. I'm sure there's awesome ways to do this. I don't know how to do that at the moment. But two variables is pretty awesome, and then you can just kind of copy this and do this a few times over. But first, we have to understand how the model works. So I hope that font is big enough. So let's pretend, if you are watching this and you can let me know if you can actually read these numbers, that would be fantastic. So in this first table, I have a property. I'm just going to use $1 million. You're buying a property for $1 million, and you're buying it at a 5 cap. Now, if you're not familiar with these terms, I've covered them all in the past like 20 episodes or so. So please feel free to go back as a refresher to those. But you're buying it at a 5 cap, which means that the net operating income is 5% of the original, 5% of the price. Now, this is a little bit false because the cap rate that you buy it at and the cap rate the person sells it at are different because you have different expenses like property tax. But I'm trying to make this simple. So you're buying it at a 5 cap, and your net operating income therefore is $50,000. Okay, let's pretend you put in $300,000 to buy this, and let's just consider that all a down payment. Okay, so $300,000 down, which means you have a $700,000 mortgage, and you're getting it at 3% interest only, which means $21,000 a year of mortgage payments. Now, if your net operating income is $50,000, then your cash flow after paying for the mortgage would be $50,000 minus $21,000 equals $29,000. $29,000 of cash flow divided by your total investment of $300,000 is nearly 10%. It's 9.7% cash on cash. Okay, so that's relatively straightforward. Those are the numbers based on when you purchased it, based on like the previous year's trailing 12 numbers, and you throw that in there, and boom, that's what you're buying it at. Okay, so on the right table, you can see your cash flow in year 0. You're at the beginning when you purchase it, you're throwing $300,000 into the deal, so you have a negative $300,000 out of your pocket into the investment. Okay, then you hold on to it, and the first year you bring in the $29,000. And let's pretend over the course of 5 years, it has cash flow that steadily increases up to a total of $39,000. Okay, and that is accomplished by increasing revenue, decreasing expenses. And in the 5th year, your net operating income here is up to $60,000. Okay, that's back to the first table. I don't know if you can see that, but the 3rd column of the first table, $60,000. So now, when you have this increased net operating income and your debt service hasn't changed, because let's pretend we have 5 years of interest only. Now my cash flow has increased to $39,000. Okay, so $39,000 divided by my initial $300,000 of cash is a cash-on-cash return of 13%. That's awesome. Okay, so we've increased our cash and cash from 9.7 to 13. All the meanwhile, your cash flow has increased from 29,000 up to 31,500, 34,000, 36,500, and $39,000 in the 5th year. I created just basically even increments of increased cash flow from the 29,000 up to the $39,000 over a 4-year span from year 1 to year 5. And that basically means it goes up by $2,500 per year. Okay, then you sell the property. Because you've sold the property with a new net operating income, a trailing 12 of $60,000, you've increased the net operating income from $50,000 to $60,000. That's an increase of 20% of the NOI. That's fantastic. That means you've bumped up the value by 20%. Okay. However, that sale price is dependent on not just the NOI, but also the cap rate. And in this situation, we model it with the cap rate going up, because you never want to model it that the cap rate stays the same or that it goes down. That's not being conservative enough. A lot of people recommend increasing the cap rate by like at least, let's say, 8 basis points per year, 0.08%. In this example, I increased it by 10 basis points or 0.1% per year, so going up to 5.5%. And because the cap rate went up, the multiplier has gone down, and therefore you're not actually getting a full 20% increase in the value. You're only getting, in this situation, a $90,000 increase in the value. Okay, so it is very sensitive to the cap rate and the NOI, that final price. Okay, so then when you sell the property, you can see that there's a $90,000 profit because we've just been paying down interest. There's no principal pay down. So $1,090,000 minus $1 million is $90,000 of profit, and you get your original $300,000 of cash back to you. So at the sale, you have $390,000. Put all these numbers together into the table, and you can calculate your internal rate of return, okay, over the 5-year period, and it's 15.5. Okay, well, that's great. 15.5% is a solid return on an investment, okay, because you have basically a cash on cash of like 10%, and then you have another appreciation of like 6% or so. Okay, so that is excellent. But when you use these charts and you want to say, well, what if the numbers don't work out that way? So what most people do is you start just fiddling with the numbers and typing in different things, right? So you'll change the NOI from 60,000 and you're going to say, oh, let's do 58,000. Okay, and so what happens is you change that number and it changes your IRR. Okay, now I'm looking at my screen and I don't see it actually showing it. So the changes that I do, I'm going to stop screen sharing and reshare it, see if it will cooperate with me. Okay, so here we go. Okay, perfect. I changed it to 58,000, 60. Okay, now it's actually working. When I change it on the screen, it changes it for you, and you can see my boxes, my cursor now. Better. Okay, that was not working before. All right, so you can see that if you change the NOI to, let's say, $65,000, now your IRR bumps up to about 20%. Okay, that's pretty cool. If you're changing the NOI to just 55,000 and your cash flow only goes up a little bit per year, now your IRR is just 10.4%. And if you don't change the NOI at all, well, your IRR is now just down to 4.1% because you still got some cash flow, but the value of the property here actually goes down. It went from $1 million down to $900,000 because the cap rate went up. Okay, so when cap rates go up, property values go down. So you really need to drive your NOI up to make sure you can swim against the current. Okay, if that's what happens. Okay, so I'm going to go back to $60,000 with a 5.5% cap rate. Let's just say if it's a 5.25% cap rate, what the difference will be now, you're up to 17.7% IRR instead of the 15.5%. So small differences in cap rates make a big difference in your internal rate of return. Okay, so that's where sensitivity analysis comes in. Instead of having to type in all these numbers one at a time, you can actually make a table with all the cells you want to add, all the columns, all the rows, and then it will automatically calculate all these things for you. Okay, so I'm going to switch this to full screen Excel mode. All right, and this data table function is awesome. So to do this, and again, I actually just learned this today, so if you haven't learned it before, then don't worry. You're probably right up with where I was. I'm not honestly familiar with like anything with Microsoft Office after like 1997, okay, because that's the Excel that I used for so long. And then they start adding all these things and it just slows me down because I don't know what all these buttons do. But they have this awesome button called What If Analysis under Data. I don't think you can do this in Google Sheets, but I could be wrong. Maybe you can, maybe it's buried somewhere. So this is very simple. On the left column, I already kind of pre-filled this with a bunch of numbers for net operating income for year 5. Okay, and so what'll happen is it'll plug in a different number, year 5 net operating income, just like I was doing manually, and it'll also check different cap rates. Okay, so this is why it's called a 2-variable sensitivity analysis. These are the 2 different variables, and the IRR that we have in our original example on top is 15.5%. So in your table, in that first cell, that where the column header and the row header meet each other, you have to put in, I'm going to do it for you, equals, okay, and you have to put in that cell. In this example, we're looking for IRR, it's H10. If you're looking for something else like sale price, you would just put that one in. But we want to look for IRR here, so I'm going to put in H10. Okay, and it puts in 15.5%, and that confirms for me that I have the right cell there. And I put 2 cells in color here. This one that's in peach color is the 60,000 5.5%, because that one is the one that matches up with my original case on the top. And then I also put in yellow the one that's at 5% and 50,000, which is the example of, well, what it was when we bought it. Okay, so to do the data table, you highlight the entire column with the headers and all of the table. So you include the headers and all the cells, but nothing more. Do not go beyond, do not go short, do exactly that. Okay, then you hit what if analysis and you hit data table. Okay, and that is, I think that might be, I'm not sure if it showed up for you, but it says for me now, row input cell and column input cell. So where it says row input cell, you are going to put in, this row right here. These are your cap rates, the exit cap rates. So I'm going to put in E4 as my row input cell, and then it'll ask for the column input cell, which is this column. We're using the net operating income at year 5, which is this cell right here, E5. Okay, I don't think that shows up for you, but it's okay because it's a pop-up box. Then as soon as I hit those 2 cells, Shazam. Okay, magical. Now I cheated a little bit because I already formatted the table to be in percentages. The first time I ran it, it just showed up in raw numbers, but then I just changed the format to percentage. So here we go. Here's your IRR. It is pretty awesome. Here's your IRR for any of these combinations. Now, if you wanted to test out 5.4% and $40,000, you have to do it manually, because to do this calculation for IRR in a single equation is unbelievably tedious, because the IRR is this function of these cells, but these cells are a function of those cells. So it would be this like incredibly long equation of nested parentheses. Very, very, very complicated to put that into one cell and then just fill down and across. So this is just awesome. It basically allows Excel to pull all those equations, put them together for you, and reference those, and boom. And how can we confirm this? Well, we look at 5% and 50,000, which is our purchase cap. And look, the IRR is 9.7%. Well, why would it be 9.7%? Because that's exactly the same as our cash on cash return, and we're buying it and selling it at the exact same price. Okay, so the IRR would be exactly equal to the cash on cash. Then I look at my example case, which was 60,000 and a 5.5 exit cap, and that's 5.5%. 60,000 is 15.5, and that matches up with the 15.5 I started with. Okay, fantastic. Now, I also have all this data in here, which is a lot to look at. I like to, the other thing that's nice about Excel, new Excel, is this conditional formatting tab. Now, they did have conditional formatting before, but it wasn't like on a tab. So now they have these cool things like these data bars and color scales. So let's just use data bars, for example. I'm going to do more rules. I'm going to use blue for positive, but I'll use like a light blue, so it's not super bold. And I'll use negative values in like this red. And I apologize because you can't see that box, but there you go. Okay, so what it did was it highlighted the cells in blue or red in amounts that are corresponding to how much it is. Okay, so let me just, I'm going to try to make that color a little bit brighter if I can. Conditional formatting, color scales, more rules, data bars, more rules, negative values. Okay, I'm going to try something a little bit darker. You can see that a little bit more. Okay, well, didn't change it much. Okay. Oh, probably because I had like two cells highlighted. Okay, well, there we go. Let's go to where we were. So all of these that have little pink amounts here that are highlighted in pink, those are all negative numbers. And then all the blue ones, those are all positive numbers. And the wider that blue bar is, the more positive it is. It makes sense. So as we go from top to bottom on the rows, from $40,000 to $70,000 of net operating income, well, yes, the higher your net operating income, the higher the value of the property will be, the higher your IRR would be. Now, in this example, is 22.9% IRR with a 70,000 NOI using a 5.6% exit cap. Now, remember, you bought it at a 5 cap. Imagine if the cap rate actually went down to, let's say, 4.5%. And let's just say that you kept your net operating income exactly the same at 50,000. So now you have a 15% IRR, even though you've done nothing to increase the value of the property, because the NOI hasn't changed. And so what's happened is the market has appreciated by way of the cap rate, because remember, you can't control cap rates. So the cap rate of 4.5 is 50 basis points lower than when you initially bought it. And so that represents itself as increased value of the property. Okay, so that's what actually happened in the past decade, like in at least, I mean, here in Dallas and in a lot of other cities, cap rates are just compressed. We call it cap rate compression. When cap rates go down, you look over here, this right column at 4.5%, your net operating income could have gone all the way down from 50,000 down to 40,000. So you've gone down 20%. You still make a profit here because the cap rate went down. So everybody made money in multifamily real estate if you bought something like a decade ago and you held on to it for like 5 to 7 years. I mean, basically, really like any real estate. If you bought 10 years ago, you've probably done pretty well with it, pretty much anywhere. When you're underwriting assets, you have to look at what cap rate people are buying it at and what cap rate they're planning and they're using on the pro forma for the sell. There should always be an increase in the cap rate because you can't assume that the market's going to stay the same or improve. You should expect it to go down. That way you don't necessarily get yourself in trouble by making underwriting with things that are relatively ideal. Okay. So I think I covered everything there. So I'll upload this spreadsheet up into the Facebook group. You can adjust the Excel spreadsheet however you want to, and you can change the variables. You can do a sensitivity analysis for any variable that's in here, and it's really pretty fun. So enjoy it. And until tomorrow for episode 131, I don't know what I talk about yet, but it'll be a quick 5-minute Friday episode, I hope. Until then, this is not legal, professional, accounting, financial, or any other advice. Please consult your professionals before making your own financial decisions. It's strictly for my entertainment, hopefully yours. If you have any more questions in the Facebook group, if you have an old question, tag me in it if I haven't answered it yet, just so I see it again. All right, have a great night. Until tomorrow.